Sorry, I was just going to say that I'm fully with you, all of you. I understand your predicament. You have been patiently hearing the panelists for session 1. You had a caffeine dose in between, and the panel 2 was very interesting. I think the audience couldn't get enough of the panelists, and you had so many questions. So it pleases me that we have a very active audience. At the same time, I also feel for you that you have to still listen to one more presentation. So I will try to keep it as short as possible, and I'm sure you will not ask me any questions, right? So with that, I wanted to thank Dr. Manish as well, for inviting me and giving me the opportunity to interact with such a wonderful audience, and B, also giving me the opportunity to present to you something which probably you will not like, because this is a regulator's perspective, and I understand that when we represent the industries, we don't like our regulators, right? So I can also tell you that I'm no longer a regulator. I'm a former regulator. So again, I'm with you on that. Anyway, so I just wanted to give you a quick understanding of what exactly are we talking about, right? I mean, we sat here, we looked at sanctions issues, we looked at transaction monitoring issues, we looked at AI enablement, adaptive models, etc. But what exactly are we dealing with? Do we have any understanding what is the enormity of our issue? So I don't know if you can read the numbers, especially the audience at the back there, but the recent best estimate, and it is still an estimate, from NASDAQ's last year report is that 3.1 trillion US dollars is the illicit fund flows. That is scary. That is very, very scary. And it includes everything. It includes frauds, corruption, tax evasion, cybercrime, drug trafficking, right? Narcotics, human trafficking, child abuse, terrorist financing, everything. So those who had a lot of questions of the operational nature on what we should do about the EDDs, etc., I think you should go back and tell your management that we need to solve this problem, right? So what exactly is happening then? If that is the enormity of the issue, then what are the world entities or the intergovernmental agencies doing it, right? So of course, we have heard of the Financial Action Task Force. From an India perspective, we had 2013 FATF review of India, and we had very positive results, very positive outcome from that. You might struggle to read this slide, especially from the far back. But what it is conveying to you is that in the 2025 and 2026, the next 1.5 years, the FATF is going to visit these many countries. Some of them it only visited 2 years ago or 3 years ago, but it is going to go back to these countries again. Some of them, it is going after a gap, 8 years, 10 years. But this should tell you that the FATF is very serious. The G20 countries which formed the FATF are very serious, and they're actually scared of what is happening right now from international efforts perspective. Now, whilst we understand at a very high level that we're dealing with a $3.1 trillion illicit fund flows, and we also understand that FATF is going to every country every few years, and they will need many, many years to cover the whole planet. Whatever countries that they have to review, they will need many years. And then they'll have to redo that. So by the time they come back to this country would have completely changed from its risk perspective. And how? So you might struggle with the last line there because it's at the very bottom. But what it says is, financial initiatives, evolution continues. We saw here, we have a gentleman who represents a crypto exchange, right? So what we are seeing here is economies are growing. And since we are sitting in an Asia level conclave, look at the countries as per GDP. You can look at the Asia view there and see China, India, Russia, Australia, right? I can hover over some of these. Japan, yes, thank you. So you can see that both in the rank 1 to 10 and rank 11 to 20, many countries from those lists are sitting in Asia. What it means is the amount of transactions that are flowing within these countries and amongst these countries is enormous. It is very likely, and I wouldn't be surprised if someone finds out by some model, right, Q to the product people, that what would be the size of illicit fund flows just from Asia or into Asia. And what are the regulators doing then? I mean, obviously, illicit fund flows is a problem, but the previous part, which is the financial initiatives are still continuously evolving. And what are these initiatives, right? Many central banks, many countries are designing their central bank digital currencies. And this is in response to the direct challenge from DeFi people, right? The decentralized finance. And they want to have their own currencies, crypto assets, which are challenged to sovereign currencies. Imagine that you're sitting in India, you can buy whatever, Bitcoin, right? That's the famous coin. So you can buy Bitcoin, you can use Bitcoin for any transactions. Isn't it a risk of your country's sovereign currency, which is Indian rupee? The government knows how much money it has printed, how much money is in the system. With your DeFi transactions, the government doesn't know. It doesn't know what's happening in the economy. It's a risk from a national sovereignty perspective. So the challenge is answered with central bank digital currencies. India is also one of the countries which is actively working on a framework, and it is also working on international cooperation by piloting transactions for settlement. It can come at two levels. One will be wholesale or corporate CBDC, and the second phase could be retail CBDC. So you and me, who still carry cash, might use CBDC. Of course, we have IPI, but CBDC is a different matter. Now, local currency-backed stable coins. This is another area where many countries are thinking that our consumers, people who live in our country and who do financial transactions, they can buy Bitcoin. Again, my favorite example. They can buy Bitcoin, and they can use that Bitcoin to further do many more levels of transactions within the crypto or virtual assets ecosystem, right? It can be used to buy other assets. It can be used to convert into fiat, back into fiat. So the countries are taking positions that why don't we encourage creating stable coins? And stable coin is a term which is easier to explain. Let's say there is a virtual asset which is pegged with your domestic currency. Example is, if today in India, ONGC, which is the largest oil and gas public sector company, if they want to launch a stable coin which is pegged to Indian national rupee, then if you buy a stable coin, which is India's ONGC stable coin, then it will always be tagged with the assurance of equivalent Indian rupee values. This again provides the opportunity to regulators or the countries to make sure that they have a visibility. on these stable coins. And there is an accountability of whoever is offering or issuing these virtual assets, that if there is a problem, then the consumer's money which is invested in these instruments is protected. The third one is regulating the activities. Now, the gentleman here who was in the first panel, he talked about that their problem is that they are not regulated. There is not sufficient regulation globally, not just India. There are very few countries on the planet right now which have figured out how to regulate and safely coexist with the unavoidables, which is allowing the virtual asset industry to flourish on their lands within their juridical or geographic boundaries. And the way they are doing that is they're designing the specific business models, so who can offer virtual assets, who can issue them in the market, who can be an exchange provider, who can be a custodian, who can be a transfer agent, who can be a settlement partner. So they are identifying or defining these business activities, and for each of them, they're creating licensing categories. So these licenses are given by the respective regulatory authorities, and once they are licensed, they are also subjected to a very heavily supervised or a regulated regime. That way, they are brought into the regulatory world. Regulating online gaming, movement of funds to and from these gaming platforms. Now, this is again, pain area. Imagine a country like India where we have, I think we just concluded the IPL. There were so many ads on Jio. I saw IPL on Jio for the first time. I live outside India, and I haven't followed IPL in a long time. But this time, I think my son was very emotionally attached to RCB, and of course, he's happy that they won. But that gave me an opportunity to watch IPL on Jio's platform. It's not accessible outside India. And when I watched that, I saw many ads for the online gaming platforms. And these gaming platform transactions are coming into your banks. And do you know if there is adequate regulation from our country's regulator around how to see this activity, how to implement your risk-based approach? Your compliance officers, are they implementing the right risk appetites around these activities? Some might say, no, we don't want to onboard these kind of players on our books. Some might be taking a different approach. They might say, yeah, welcome. Come one, come all. But I think the regulators are feeling the pain. There are countries like the UAE, where I live. They have established a separate, dedicated regulatory authority just to regulate the commercial gaming activities. Now, the next one is interesting. You must have heard that India is allowing or going to allow the connection of our domestic UPI transactions to the UAE's domestic transactions. This is a new trend, and there may be geopolitical angles to that because we see that there is an over-independence on SWIFT, and even though SWIFT as an organization is based in Belgium, it also provides the full transaction dump to the US Treasury. Don't ask me why, but they provide US Treasury the full transaction dump, and the US Treasury has access. They can see whether your country has bought weapons and whether they have been settled by any MT-700 series transactions, which they can see, identify buyers, identify suppliers, and then they can sanction them, right? India is buying Sukhoi, from Russia. Let's sanction the Russian defense entity. India is buying S-400, defense system. Let's sanction Rosoboron Export, which manufactures that. So the point is, there is a sovereign risk to the countries that their transactions are seen by other non-party countries. And how do you stop that? You don't have, an alternative. Not every country want to settle trade with India in Indian rupees, right? Or if you're doing trade with China or Russia, likewise, whether we can settle with Russian yuan or Russian ruble or Chinese yuan. So with the friendly countries, we are now connecting each other's domestic platforms because they are indigenous platforms. But what it means for compliance officers is the typologies or the behavioral patterns of the risks that exist in other countries' domestic transactions, they are going to come and meet your domestic transactions behaviors. And when these two different typologies or risk patterns commingle, you're going to have a massive challenge. You don't understand IPI risks at the moment or UPI payment risks at the moment. Prepare for a shock that your risk is going to get increased with not so much understanding of other countries' domestic transactions. But this is a trend, right? We want to connect these domestic transactions with each other's countries. The next one is regulating. I think both the panels we talked about artificial intelligence, machine learning, AI, ML. We talked about regulating this as well, right? And what does regulating this mean is, from the regulator's perspective, when financial institutions are implementing solutions which are enabled by these AI and ML models, then the regulators, first of all, are not happy. And they want to make themselves happy only after they can see that the compliance officers are happy. And how they will ask the compliance officers to demonstrate how they have assessed these models in terms of their accuracies, right? And that can only happen when you have very robust AI, ML specific model validations. But until that happens, this is an area which is, maybe the industry is adopting it and the regulators will wake up to regulating it. I've written that as a concern because I know personally some regulators, although this is not very publicized, certain regulators are already trying to identify how they can regulate the adoption by financial institutions of these models. And the last one is the SupTech, which is the supervisory technology adoption. So, RBI or other regulators in Asia, they have been collecting enormous information from financial institutions. And they collect it at various time spans, annually, quarterly, monthly, I don't know, weekly, daily. But there's a lot of information which these regulators gather. And it's in very, siloed basis. Like Financial Stability Department will gather its own data and the other departments don't know. Supervision Department will gather data and other departments don't know. Within supervision, you have prudential authority or prudential supervision, and then you have financial conduct supervision, which is financial crime, market conduct, consumer protection, etc. They don't know, each other's data collection. Now this is all getting, at a single view interface. They are adopting technologies which will allow them to have a single customer view equivalent for their institutions that they regulate, that they supervise. And there's a lot of data analytics behind that. And they want to see impromptu models which will provide them on-the-spot insights on the regulatory health or the supervisory health of your institutions. So I think India is also adopting that. Now, what are the concerns then from the financial institutions' perspective, right? So they are, of course, with these activities which we saw on the previous slide, gaming platforms, crypto activities, stable coins, CBDCs, of course, government initiated, faster payments getting connected with each other. All of these activities require you to look at your compliance risk appetite. You need to revisit your risk appetite more often than we may declare that we will review it every 1 year. Maybe, like you need to review your customers on a dynamic basis, You need to review your risk appetite on a dynamic basis, right? Then so much data is collected by regulators, so much data is needed even by you. So you need to think about data lakes or data marts where you don't have to depend on your technology, your operations teams, your business segments to give you the data that you need from compliance perspective. Because when your regulators ask data, they don't go to your trade finance team, they don't go to your operations team, they come to compliance. Their point of interaction is more with compliance. They want single true source of data from compliance. That means your name, your department is on the line for the accuracy of that data. And what's the best way than to be technology enabled? You can have compliance data where there are intelligent rules which create specific information tables, and you can fetch that information from whatever systems you have within your banks, and then you can maintain that information with you, which is regulatory submission enabled or submission ready. Then there are APIs as well, right? APIs, I hope everyone understands. So this is the mechanism where two different systems interact with each other and then they share data with each other. So data required for subtech, data required for KYC utilities, which are transferable KYCs, institutional risk assessments, etc. All of that require data sharing, and you can have these APIs ready. So these are obviously operational readiness concerns. But the compliance officers have, again, coming back to the previous two panels that we saw, I think your agenda also is quite flooded with these two activities. One is sanction screening. We saw that what are the practices. I heard a lot of people saying, they have good systems, like Focosoft is a widely regarded as an industry leader in European or US world. You have nice systems. You take configuration help, from the service providers, and then you also do some tuning when you implement it. You might also have if you are a large organization, you might have a tuning capability where you tune that system on a more regular basis. You also will have list management. There's always a challenge on new sanctions by OFAC, UN, EU, etc. And you will have your own list management to manage those new designations. I hope we have enough oxygen in the room. Then, obviously, what we're doing in sanctions is, name matching. Whether Sunil Kavishwar is on Al-Qaeda terrorist list or not, because he's my customer, I need to check whether if there is a name match, then is he the same person or not. So then, effectiveness versus efficiency, right? This always a challenge, because you will do some alert scoring, you will do some alert prioritization, maybe you will suppress with some rules certain type of alerts to reduce your false positives. Then you will go to some supervised, decision learning models where your level 1 or level 2, sorry, can you keep that quiet, please? Excuse me, can you keep the volume down? Yeah. Where you have, thank you. So there are some decision learning models we saw in Dr. Manish's presentation, where these models are implemented based on how you have previously reviewed your certain type of alerts. So these models understand your previous decision making, and it adopts so that you get lesser noise in terms of false alerts. Then when you have these, I think we heard 700 names were removed from the JCPOA withdrawal, and 700 names were added. I would say I would have expected an example when Russia sanctions came, both from UK, both from EU, and the OFAC as well. That was scary, and I'm glad that I had resigned from FAB as their global head of sanctions by the time Russia sanctions came back. So thanks to Russia that they did not invade Ukraine until I resigned from FAB. But that's a challenge, and your list management is dealing with the challenge. So you might have some bots who will scan your database quickly in the evening, the moment OFAC sanctions are announced, night 12 a.m. India time. You have bots scanning your database at a rudimentary level, maybe 100% match only then, but you have some sort of assurance that by the time tomorrow's list is ready, it is screened against your database, and you have the alerts, you have done at least some preliminary search, right? Then you have other challenges, which is the lack of very good guidance from regulators, as well as tools and technologies to help you understand the dual-use goods. Now we are seeing there's so much talk recently with what happened in Operation Sindoor on the drones as well. And these drones are made by people who are using the technology which is available even to college students. So how do you define any business activity, whether it is for civilian, simple commercial purpose, or it is for creating a bot which is going to carry some load on it and it is going to explode on some identified target or a building? You don't know that. So how you as compliance officers get enabled with the right set of tools and technologies, and even the policy level understanding that how do you make your trade finance people understand what is exactly the flag for dual-use goods. Again, the 50% or more ownership rule, both from UN and OFAC sanctions. This is very tricky, right? Because even sometimes OFAC or the UN don't know if a sanctioned person owns any stakes in a company or has other interests which are yet to be identified. And even though they are not identified, and even though they are not directly sanctioned, they are to be treated as sanctioned because it is 50% and more ownership or controlship. Then how do you identify that? How do you make sure that your institutions are safeguarded against exposure to sanction violations? I think there are some third-party tools, like I can think of a name. I think Karen. It is a company which is established or found by ex-US Treasury retired people, or ex-US Treasury people, and they have some very sophisticated data scanning capabilities, and they built a database. They continue to build a database, but I think within India we should have that capability where we should be able to identify 50% or more ownership. And then there is a challenge of secondary customers. I can tell you, I have a non-resident account, and I obtained some debit cards as well as some credit cards for my family members. They came in the family members' names. And I can tell you that my bank, which provided me, it's an Indian bank. I wouldn't name it. Some of you, might be sitting from that bank here. That bank has not screened my relatives' names in whose names I have requested those cards. So you don't know sometimes that your secondary cards, additional debit credit cards that you provide to your customers, although you know the primary customer, the secondary customer could be an actor in some illicit activities, and some of the institutions don't even store those names. Those names, if stored, are not fed into your screening, the batch screening, etc. And that's a serious gap. So regulators are worried about such kind of concerns. Transaction monitoring, we have a similar pattern where we saw in the panel just now typologies or scenario-based detection. Obviously, transaction monitoring is post facto. We had a question from an audience on more real-time basis. I'll come to that point. But obviously, if you design a detection scenario, you're going to get a result only based on what you've designed. You're not going to get something for which you have not designed. That means there is a larger activity which your system is unable to identify because you don't have the detection scenarios for that activity, right? But how do you deal with that problem? Then you have manual adjudication, right? You have L1, L2 teams sitting on those alerts. And then to make sure that that alert adjudication is accurate, you have 2.5 line of defense, or what you call assurance team, right? Which sits within compliance and it comes after you. Okay, in the last month's 2,000 alerts, I think 5% alerts are inaccurately adjudicated, right? So they come after you to improve that accuracy. And again, this is a very long process because alerts generated 1 month, 2 months ago, reviewed them in that 30, 60 days timeline. Your assurance team will tell you after 1 month or maybe 3 months of what happened in 3 months ago. So your learning is always reactive, right? And then there are some FIU-worthy events which either get missed because you have gaps in your detection scenarios, or they get missed because you have delay in your transaction adjudication, because your review process is longer. Then again, effectiveness versus efficiency, right? Your library is outdated. I heard some of the people saying maybe we'll look at certain rules 6 months later, but do you have a need, or is there a sectoral need to look at that more frequently than 6 months or 1 year? New scenarios and continuous tuning based on risk events or anything which is flagged by your FIUs. That is again reactionary, but it happens and it takes time, right? Sometimes you get, because of some specific activities, you suddenly get alert spikes. And then you have to get consultants, third-party contractors, 3 months, 6 month project, and then give them those alerts to solve, right? Again, the quality is questionable. You might be doing good job in governance, but it is still questionable. And like most of the panelists said, 90–95% of the alerts are tagged as false positives. But you are relying that it is accurately adjudicated. That's why it is 95% false positive. We don't know whether there was something material which is missed in that, and you will probably get flagged by the FIU. Now, there are some look backs because some bank get into trouble for some transactions, something happens, some names comes up, then your FIU or RBI or even, enforcement directorate in other countries, there are prosecuting agencies which can send circulars to financial institutions to screen transactions or databases for some specific events, like Chinese typology that happened in UAE, or I think the Hong Kong and Singapore corridor for trade finance. I think it was 2015, was it? Anyone remember? I think Anant Vihar branch, Bank of Baroda case. I don't know if you guys know that case, yeah? So if something like that enormously happens, then your regulators will come back to you, okay, scan your transaction history, look at your alert spikes, look at what you've done, etc., and then do a look back. So this is again a very reactive mode. So then, what could you do, right? So this is the future that should be present, right? I mean, I shouldn't have to speak on those previous 2 slides because you are expected, if I'm the regulator, and I was a very strict regulator, believe me, so I would have expected my financial institutions to put these as the bare minimum in terms of their risk-based approach, right? So we have a very static way of looking at risk assessment, customer risk rating, 5-year, 3-year, 1 year, very standard, right? Can we not move away from that static model? Can we not look at our customers on a more regular, at a dynamic level? Let's look at perpetual KYC. I know, in 2013, there was a speech from one of the assistant governors of India, and he talked about perpetual KYC in that speech. I can pull that out, privately. Targeted behavioral statistical models, and I think Solytics is proudly able to answer to some of these. But there are some integrated or aggregated intelligence models that you can put, which will integrate your perpetual KYC which will look at your customer data, which will look at your transactions of your customers, and then collectively, with those models, they are able to flag certain anomalies or infractions which your detection scenarios are not capable to identify. Right? So obviously this is moving away from the system that your bank has bought 10 years ago, 5 years ago, Mantas, SAS, I don't know, Norcom, right? Get Solytics. Continuous learning and tuning, right? This is again a learning that you can't have a static approach to tuning, which is I will tune my system 6 months or 1 year or 2 years later. You need to have a more regular, more dynamic approach, which is ready to tackle any industry event. You learn of some event, there is a fraud that comes into picture, you go back to your tuning and you tune your system. Right? You have last week's transactions, tune your system. So it should be more adaptive, it should be more frequently tuned. And then the last point, I think this is the key theme of the two panels, which is the AI adoption. So when you are employing AI-enabled solutions, you need to make sure that you understand them very well. Obviously, some people called it black box, and it is black box to some extent. But if it is being sold to you by a service provider, then the service provider has gone to the efforts of building that model. They understand it. So make sure that as compliance stakeholders, you understand from them that how exactly it is going to behave, what exactly it is going to consume, what processing it is going to do on your data, and how it is going to provide certain output. Unless you are satisfied with the robustness or the accuracy of those models, you can't explain that back to your regulators. Right? Otherwise, if RBI asks you to explain something, you can't say that, Dr. Manish, please, go to him, ask him to explain that to you. So you need to understand that. And then get comfortable whether you want to employ supervised models where you have, like decision learning systems. Level 1 is done by the AI, level 2 is done by manual person who says, okay, AI has done the right job, I agree, done. So level 1 is automated, level 2 is maybe manual. Or even go one step further, level 1, level 2 automated, decisioning, and level 3 someone physically sits and says, yeah, that's correct decision, right? So you can think about supervised, completely non-supervised, or a partial hybrid approach, but you need to give it a time to be able to satisfy yourself, and then you have the confidence that you can talk to your regulator on how exactly are you finding it comfortable, right? So that's it.